All right, so we are on chapter 18, and so in my last email, I said that things were going to get a little bit easier. So, what we went through in the previous chapters, job costing, process costing, ABC, equivalent units, that gets to be some pretty tedious stuff, and it can be a little overwhelming as well. And so chapter 18 is going to lighten it up a little bit. It's really useful information. And it's kind of fun, but I'm kind of a dork, so take it for what you will. And so what we're going to jump into is the idea of a contribution margin. And so contribution margin simply says, if I take my sales and I subtract all my variable cost, that's going to tell me how much I have left over to contribute to fixed cost. And so what we worked on before and what you guys have been used to is in a traditional income statement, we've taken sales minus cost of goods sold. And it gives us our gross profit. And that's good information. That's useful. We want to know how much does our product cost and how much profit do we have on that. But a contribution margin, it just simply takes sales minus our variable cost. And so whereas our cost of goods sold actually takes inside of that, has both fixed and variable costs both, we're going to separate stuff out. So actually we don't care for a contribution margin income statement whether it's a product cost or a period cost. We just want to know, hey, is it fixed or variable? And so that's going to come in really handy when we come into things like hey, what's our break even? When we're making decisions, like, hey, what do we really charge for this product? And so it comes in really useful, and it's not too bad to do either. So let's go ahead and jump into problem 18-1. And so in problem 18-1, so we have the following costs from the production of sale of 100 drum sets manufactured by Tight Drums Company. And they sell the drum sets for $500 each, and they have a 25% tax rate. So then it breaks down the costs based on variable and fixed. So let's jump over here to our contribution margin income statement, and first let's plug in how many units we're going to sell. So it says the sale of 100 drum sets. Okay. So the first line is the same as a normal income statement. We want to know the sales. And so $500 each times our units gives us our total sales. And then instead of calculating cost of goods sold, we're going to calculate just the variable cost. And so they're really nice. They break everything out. We don't have to do a lot of calculations. So we have our plastic is $17,000. Our assembly is $82,000. Drum stands are $26,000. And then next one is our sales commission is $15,000. And so if you guys remember back, if we were doing a regular income statement, sales commissions, that's not a product cost, that's a period cost, so that would usually come down below gross profit. But for a contribution margin income statement, it's included in the contribution margin because it's a variable cost. So variable cost up top, fixed cost down at the bottom. And at the end, we'll get the same net income amount. We're just breaking it out separately. And so our total variable cost is $140,000. And now we can just go ahead and plug in our fixed cost. So taxes on the factory is $5,000, $10,000 for maintenance, $40,000 for depreciation, $10,000 for lease, $35,000 for accounting salaries, and $125,000 for admin salaries. That's going to give us our pre-tax income, so that's going to be our contribution margin minus all our fixed cost. Gets us to a pre-tax income of $135,000, and to get our tax, we just take 25% of that, and that gets us down to a net income of $101,250. And so what this is saying, it's saying that, hey, after we sell this for $500,000, that once we have all our variable costs, we're going to have $360,000 left over to pay for fixed cost. And that's important, because when we pay for every unit we sell, our variable costs are going to go up. So if we don't sell any units at all, we're not going to have any variable costs. It's going to be zero. But our fixed costs are always going to be there. So whether we sell 1 unit or 1,000,000 units, our fixed costs are always going to stay the same. And so it also wants us to calculate a cost per unit. So we can just do our sales divided by our units. And we'll do that for each one of the cost here. Let's just lock that down. We can drag it. So our variable cost per unit is $140. So we sell it for $500. Automatically, $140 goes out towards variable cost. So we have $360,000 or $360 per unit to contribute to fixed cost. It also wants us to calculate on a basis of percentage of sales. So that's just 500,000 divided by 500,000, and then variable cost. So what this is saying is that every time we make a sale, 28% goes out the door to cover variable cost, and then we have 72% left over to handle the fixed cost. So pretty straightforward, kind of fun, and I think much easier than some of the other stuff we've been dealing with.